Hello and welcome to Business Standards Morning Show. I am Ruchika Chaturvanshi and let us take a look at the stories of the day. With their strong entry into the Indian payment scene, are the likes of Google, Amazon, WhatsApp, and Facebook ready to make the next move? What does the Reserve Bank of India have to say about all this? Let us look into these issues in detail.
The RBI is closely watching the recent move by Equitas Small Finance Bank to tap into the user base of Google Pay for garnering deposits. The regulator wants to gauge the deal's implication on the banking landscape. Within days of the Equitas move, Amazon Pay also entered into a similar arrangement with wealth management platform Kuvera, and the RBI was said to be uncomfortable with the idea of tech giants getting linked with retail deposits. So why is the RBI so concerned about this development? Before we can answer that, we need to look into what the Equitas deposit scheme is and how it works. Equitas has announced that Google Pay users can open a fixed deposit account with it using Google's unified payment interface. How does this work? A spot in the Google Pay business section has been given to Equitas. Similar to a QR code, a spot is a visual code that is only available for Google. When a user scans a spot for a given business, it takes them to the platform or website of that business, which in this case is Equitas SFB. After the deposit tenure has been selected and the amount finalized, the payment is made using UPI. Google simply debits the account linked with the UPI ID and credits it to Equitas. Google's role ends with the payment transfer. Subsequently, the relationship moves to Equitas and the customer's bank account to which the UPI is linked. Equitas is simply using Google's distribution channel as an alternative to reach out to new customers. Meanwhile, Google charges a fee from all businesses using spots on Google Pay. Now we come to the sticky part, the RBI's concerns. The real concern is Google's involvement here. That's because the RBI keeps big tech, which includes companies like Google, Amazon, Apple, Facebook, and Microsoft, under scrutiny. In the RBI's words, these companies are too big to fail and difficult to regulate. The experience of developed countries shows that these companies are not easy to rein in. Consider the following scenario. What if all banks end up having a spot or QR code on the big tech platforms? That would lead to big tech becoming the term setters for these banks. We could end up with a situation where these platforms could then pull any bank out of the system for failing to meet the criteria set by the tech firms. Customers, by now comfortable with using the tech firms' apps, might just not bother going back to any bank that is not part of that ecosystem. As a result, the bank concerned might fail, and in an interconnected world, the entire financial system could go down with it. Last but not least, in such a scenario, these for-profit tech giants could end up having a say in public policy matters. Equitas, its technology provider Setu, and Google have all clarified that the tie-up should not be interpreted as anything more than a usual product offering. In a blog post, Google Pay has refuted claims that the search giant was trying to encroach into the banking territory. Google is already a leader in the UPI space, and the UPI payment mode processed 3.5 billion transactions worth 6.4 trillion rupees in August. To put these figures in context, UPI transactions during the month were over 9 times higher than Immediate Payment Service or IMPS in volume terms and more than twice as much in value. So what happens going forward? For now, the Equitas deposit scheme continues as any other product. Meanwhile, the RBI is carefully weighing if this could eventually lead to Big Tech's backdoor entry into the Indian banking system. The regulator's stance on this issue may be reflected through a working group panel report on digital payments.
There is a lot of excitement around JioPhone Next, Reliance Jio's first 4G smartphone. So obviously there is a lot of speculation on the internet. We are bringing to you the most authentic and confirmed details about the phone so you can set your expectations right.
The much anticipated JioPhone Next, arguably the world's cheapest 4G smartphone, is set to be launched soon. There has been no dearth of hearsay and speculation since Reliance Industries CMD Mukesh Ambani announced this phone at his company's annual general meeting in June this year. Co-developed by Reliance Jio and Google, JioPhone Next is going to be based on a customized version of the Android operating system. What else should we expect from this product? Let's take a look. The JioPhone Next will be a made-for-India smartphone with an emphasis on content and internet services. It is based on an optimized version of the Android platform Android Go, which has been developed by Google specially for the JioPhone Next. The smartphone will have access to Google Apps ecosystem through Play Store, but not all apps will be available at the time of the launch. Google CEO Sundar Pichai earlier said that the JioPhone Next 4G smartphone will enable users to consume content and navigate the phone in their preferred language, deliver a great camera experience, and get the latest Android features and security updates. Besides, the JioPhone Next will be packed with features like the Google Assistant for hands-free operations, automatic narrator for accessibility services, language translation, smart camera with augmented reality filters, and more. Now let's take a look at the expected specifications and features. The JioPhone Next is expected to be powered by a Qualcomm processor paired with up to 2 GB of RAM and 16 GB of inbuilt storage. The phone is expected to have a dedicated micro SD card slot for storage expansion. It may have an embedded Jio SIM or be a network-locked smartphone restricted for use only by a Jio SIM. It is expected to have an HD resolution screen of a size between 5.5 and 6 inches. The phone is expected to be powered by a battery of up to 4000 mAh capacity. As for pricing, the JioPhone Next is expected to be sold in the retail market for around 3,500 rupees. Important to note that Reliance Jio might attach riders with the $50 price tag, just like it did with its 4G feature phone, JioPhone, which was launched in 2017. Though it was effectively priced at zero, Jio had asked for a one-time refundable security deposit of 2,000 rupees for the JioPhone. Later, the company had also introduced an exchange program where customers could avail of the JioPhone in exchange for their existing 2G feature phones.
If you have ventured out recently, you would have noticed that the traffic is back. The metros are filled during the office commuter hours. Why is this happening? Because offices in the country are slowly opening up, employees are being called back. One of the country's biggest employers, the Tata Consultancy Services, has said that it will have 90% of its employees back by the end of this year. While work from home has happened as a knee-jerk reaction to the COVID-19 crisis, the return to office strategy is very well thought through. Here's a look at how India is coming back to work.
Last week, one of India's biggest employers, Tata Consultancy Services, said it would ask a majority of its employees to return to offices by the year end. Over the past few weeks, Infosys and Wipro have also indicated their intent to have workers back in the offices as long as they are vaccinated and COVID-19 case numbers are down. With about 13 million people employed in the Indian IT sector, its return to office strategy will likely become the blueprint for other sectors. Here's a look at how India Inc. is planning its return to office. TCS said it expected 80% of people to return to office by year end. The IT major will initially have almost all staff back in the office before switching to a hybrid model under which only 25% of staff will work from office through 2025. The plan is based on current projections that a third wave will either be less severe or won't be there at all. TCS said 90% of its staff had received at least one dose, compared to the national average of nearly 40%. For most employers, having employees return to office is a conundrum. While there is excitement and optimism with a set of employees, there is also huge reluctance with another set. Companies too have saved on costs by giving up office spaces and gained from the ability to tap remote talent during the pandemic time. A survey found that 60% of tech firms now expected every second employee to come to office. A separate survey of employees found that 6 out of 10 people would prefer coming to office just for 1 or 2 days in a week. Only 2 of 10 respondents said they would agree to come to office daily. The firms are lining up a slew of incentives to attract people back. Some IT companies have hired new workers at double the salaries, besides doling out eye-popping goodies like expensive cars and vacations. Others are giving out more reasonable perks like childcare arrangements, transport facilities, and relocation allowance. Tech startup Meesho recently said it would give a 10-day break to all employees during the Diwali period. Firms, on their part, are working to strike a balance between employee safety and identifying jobs that need collaboration and office infrastructure. 2 new ways of work seem to be emerging. These are cloud shoring and hot desking. When employees return to office, they will have to grab seats on a first-come, first-served basis. This is called hot desking. Separately, firms, especially in the IT sector, are finding ways to tap talent cross-border and deploy on projects the world over. TCS, Infosys, Wipro, and most other IT firms have laid out plans to build a distributed workforce across geographies connected through virtual means. SAP India is considering hyperlocal workspaces, which are temporary, makeshift offices close to where employees are. These will essentially be small hubs, and employees will not necessarily have to go to the main campus. That said, hybrid work has its downsides. The IT sector accounts for 40% of India's office leases, and the remote working arrangement will lead to a drop in the demand for new commercial spaces. Also, businesses that depend on the office economy, food and beverage, hospitality, retail, and maintenance are also expected to suffer. The other issue is employee compensation for those who pick remote work. In the US, tech firms like Google and Facebook are receiving backlash for cutting down salaries based on the city the employee chooses to be based from. But like TCS said last week, the return to office will involve a lot of trial and error. Let's see how things unfold.
The gold price rally has fizzled out with the fall in COVID cases and rebound in economies around the world. They are down by almost 15% from all-time high levels. The Fed tapering poses further risk to gold, but a possible third wave could revive interest in the precious metal. Back home, the onset of festival season could revive consumer interest and also increase the prices. Is buying gold a good investment strategy ahead of the festive season? Let us find out.
The dizzying rally in gold prices at the peak of the pandemic has cooled off now. The prices of the precious metal have fallen from an all-time high of Rs 57,000 to 46,000 to 48,000 rupee mark. This means that gold prices have corrected by over 15%. In 2021 so far, gold has offered negative returns in 5 out of 8 months. Then what's denting its sheen?
And we have seen that at least in 2021, 5 out of 8 months gold prices have fallen. The main reason why the bullion has fallen, that's because of the global economy has rebounded from the pandemic and smooth vaccination program. Although there are concerns of Delta variant of COVID-19, but the way the economies have rebounded, it's hurting the sentiment in gold. Look at the SPDR gold ETF holdings at the beginning of the year. 31st of December 2020, holdings were around 1,170 tons. On 31st of July, holding was around 1,000 and I would say 31 tons. And on 3rd of September, the holding at the SPDR Gold ETF was at 998 tons, which means the smart money investors are withdrawing from SPDR Gold ETF. SPDR Gold ETF is the world's largest gold-backed ETF. Friends, we have seen the dollar index has also risen in August. In fact, in August, gold has fallen by 1.5%. MCX gold, particularly, I'm talking about. It has fallen by 1.5% or around 720, 730 points. The main reason is the dollar index. Dollar index has risen by, in fact, 0.60, 0.61. The reason behind rally in dollar index is Fed. In August, a few of the Fed officials have said that there is a possibility of early tapering than the market is anticipating. In fact, Jeremy Powell, Fed chairman at Jackson Hole, he did emphasize that yes, tapering of bond buying may begin this year itself, by the end of this year, which means the dollar will be withdrawn from the system. Stimulus package will be withdrawn from the system in tranches, of course. So that's why the value of dollar has increased and dollar itself has risen. The sentiment is overall still a little bit bearish in gold. We may see some more weakness in gold prices going ahead, but the focus will be on September 21st and 22nd when the Fed will speak about monetary policy.
Let's take a look at what the tech charts are signaling for gold prices.
Spot gold prices on charts have breached consolidation range above $1,800, respecting major support at 61.8% retracement at $1,675 range, which may pave way for further upside. A trade above $1,833 per ounce will confirm the bullish momentum in the prices, eyeing targets near $1,817 and $1,920 per ounce. The long-term bullish outlook, however, is deteriorated with rate hike in sight by the year 2023. Investors who are looking for short-term gain can enter long on any decline till Rs 46,000 per 10 gram, while those who are holding long positions may get upside till Rs 49,000 and 51,200 rupees per 10 gram in coming months. So overall, if we see, gold price outlook is still bullish and investors may enter in long, as any hurry in Fed tapering may cause some hiccups in US economic recovery, which may backfire to support overall job market recovery.
As the outlook for gold remains somewhat tepid, the question arises whether gold should still be a part of your portfolio or not. Emerging market guru Mark Mobius recently made a case for investing in the yellow metal. Here is what he said in his interaction with Bloomberg.
A lot of our data is compartmentalized in silos with different entities, and we have little access to it when we need it the most. But you own the data that you've provided to banks, insurance providers, and other such entities. And you should be able to use it to access credit and other financial services. So now, there's going to be a framework to help you do just that. You will be able to gain control over your data and move it from one financial service provider to the other with just a single click.
Suppose you need a small loan, which banks and other financial institutions are unwilling to offer for lack of a credit history. That's the situation with many people today. Now imagine there is a fintech app that looks at your history of timely bill payments for a prepaid mobile phone, for instance, and uses that as a credit history to offer you the loan you need. That's precisely what the new account aggregator framework aims to do. Let's understand how it will work. You apply for a bank loan. In your first meeting with your relationship manager, they ask you to furnish a long list of documents, from bank statements to everything else. The process can be tedious. With this new framework, you could simply ask your bank to share your account statements with the institution where you have applied for a loan. You could just be sitting at your home. This control over your own data is one of the provisions of the Data Empowerment and Protection Architecture, or the DEPA. The DEPA talks about the creation of consent managers, which won't read user data but enable its encrypted flows between different financial service providers. These consent managers will be known as account aggregators. They have been designated as a new class of NBFCs by the RBI. Now, of course, this ecosystem of enhanced data sharing will work only when a large number of financial entities join and become financial information providers, or FIPs. So far, 8 Indian banks have joined the account aggregator ecosystem as FIPs. These are State Bank of India, HDFC Bank, ICICI Bank, Axis Bank, Kotak Mahindra, IndusInd, Federal, and IDFC First. Becoming FIPs in the AA ecosystem would mean that these banks and other financial institutions would have to share your data with an account aggregator. If you provide your consent for it, FIPs can subsequently apply to become financial information users, or FIUs as well. FIUs are entities that will consume the data that you share with an account aggregator. FIUs can include a bank giving out a loan, an insurance provider, or a wealth manager. No entity can only apply to become an FIU. It must first register as an FIP and then register as an FIU. So, a bank must first agree to share the data of its customers with account aggregators. Only then can it access customer data to provide loans. FIUs and FIPs must be registered with and regulated by any of the 4 regulators. These 4 regulators are the Reserve Bank of India, the Securities and Exchange Board of India, the Insurance Regulatory and Development Authority, and the Pension Fund Regulatory and Development Authority. So, there's ample incentive for financial entities to join this data-rich ecosystem. Currently, 4 account aggregators have got operational approval to start business. These are Finwoo, OneMoney, CAMS FinServ, and the National E-Governance Services Limited. 3 others, including PhonePe, have got in-principle approval to operate as account aggregators. Now, account aggregators will be data blind, meaning they won't store or process a user's data but only enable its encrypted flows between FIPs and FIUs. They can only share the data which a user has consented to share. Users can choose the accounts they want to link with the account aggregator. The account aggregators will monetize by charging FIUs and/or customers a certain fee. So how will the account aggregator framework change things for Indians? Well, besides enhancing the user experience, it will also massively streamline the availability of credit for individuals and small and medium enterprises. There are so many people who are looking to raise working capital to start their own enterprises. A lot of these people are based in rural areas and lack access to traditional financial institutions. They also have no or little of the credit history needed to become eligible for microcredit. But with the account aggregator framework, if you can show that you've regularly paid your telephone or electricity bills for the past 2 years, it would be treated as your credit history by a lender, who may then agree to provide you the credit you need. The telecom example isn't far-fetched. In fact, Nandan Nilekani, chairman of the RBI Committee on Deepening Digital Payments, said that talks were on to get the telecom data on the account aggregator network. According to the RBI, the estimated debt requirement for Indian MSMEs points to a colossal credit gap of over $219 billion, outstripping the available supply of finance in the formal sector. By ensuring greater access to data, the account aggregator framework might help ensure more equitable access to credit.
That's all we have for you today. We will be back with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.